In this video, I want to talk about AMP first because they're being on the news non-stop and not exactly for good things, but I want to dig into the company just a tiny bit and share some of my thoughts on that. And then I want to talk a little bit about buy now, pay later, especially Zip heading into the Middle East. And I want to share some of my thoughts around some of those buy now, pay later companies and how they might perform with the macro backdrop. If you do learn something new, it would mean the world to me if you could just gently smash a like button because that will help this video reach more people. And no, this video is not financial advice or recommendation to do anything. It's just general information for entertainment purposes. So without further ado, let's go. The first thing we'll talk about is AMP Capital. And then let's talk about the buy now, pay later companies because I know you guys love that. Now with AMP, they're being on the news for basically all of the wrong reasons. So I want to share my thoughts and then we'll look into some fundamentals. One of the main reasons why I still know of AMP is because I read Dr. Shane Oliver's writing. I think his macro insights are incredibly reasonable, very non-hyped and non-FUD type content, not like Harry Dent's research where it's 90% a crash, our entire market is going to go on fire type content. It did catch my attention a few weeks back when AMP was trying to sell its private markets division to Areas Management Corp, and they want to spin off the private markets, which consists of the infrastructure and real estate units, to be an independent entity in the ASX. When we look at the business unit performance, the Australian wealth management arm is doing relatively well. You can see that they have increased their asset management by $1.6 billion to $125 billion during Q1 2021, which is great to see. I have totally forgot that AMP even had a banking arm, and I think this is such a small part of their business. It's not really going to make a difference anyway, but it did grow. Their loan book did grow, which is nice to see. But their core business in AMP Capital had a net cash outflow, which means that people are pulling out their money. That's never a good sign for an asset management company. And they do have a New Zealand wealth management arm as well, but relatively small. So before we go further, one of the things that I always ask myself is, am I even interested in the business? It's not always just about making money. For some of you, maybe, but for me, I have to be at least interested in the business model. And frankly speaking, I am not that interested in AMP. That's one of the reasons why I have not done a video on it until now. Let's just pretend that I am interested just so that I can show you what are the next two steps I do before I dig even further into research. The next thing I like to do is come to Morningstar and I like to check the valuation gauge just to see if there is enough incentive for me to keep digging. Now, it seems like to me that there is a 33% discount. Well, that's what Morningstar is saying. But you should always take this with a grain of salt and always read the analyst notes because you may or may not agree with the assumptions and the strategy that they are outlining for AMP. But their core idea really is in AMP's demerger. Given that there is some kind of incentive to keep digging, so the step that I like to do after that is I like to come to ticker. And then the first thing I like to do is I like to look at the balance sheet, but looking at the ratio is probably a little bit faster. So on a return ratios point of view, return on assets, return on capital, return on equity, it's pretty poor all over the place. And you probably already know that. At the same time, if we go down a little bit further, you can actually see that the current ratio, at least the short-term liquidity side of things, it's just really poor at 0.37. To give you a better visual, I went to Simply Wall Street just to show this a little bit more clearly. You can see that there is $7.88 billion worth of short-term assets versus $21.54 billion worth of current liabilities, which means that if there's some kind of event, it's going to be really hard for them to deal with these external shocks. That's not exactly a great thing. And what I like to do after that is go to estimates and then look at the revenue growth, because these numbers are estimates and these are analyst projections of what those estimates are. And analysts are expecting the company to grow their revenues by 25% over the next 2 years. And I think this is purely because of the demerger. At the same time, the EBITDA is going to contract by 7.5%, which is a sign of margin compression. So the final thing I like to do is go to valuation, and then we will go to next 12-month EV revenue and next 12-month EV EBITDA. And then we'll drag it to 5 years so that we can see where they are currently at. Now, these numbers could be wrong, but you can see that their next 12-month EV EBITDA or EV revenue is incredibly high at around 60 times. So from my perspective, there are a couple warning signs. Firstly, I'm already not interested in the business model or the business itself. And secondly, it seems like there is a falling knife here and I really don't want to catch a falling knife. And there is a lot more uncertainties around the demerger, how that demerger is going to pan out, and whether they will properly execute on the plan and finally get back on the right tracks. So from that perspective, I think there are a lot more better opportunities out there, either in the US, UK, or even in Australia. So AMP I'm just not interested. So, okay, let's talk about buy now, pay later, especially Zip entering into the Middle East. When it comes to Zip expanding into Europe and Middle East, this is definitely not news because we know from the past that they had an equity stake in Twisto and Spotty. Twisto is the European buy now, pay later, and Spotty is the UAE-based buy now, pay later. This whole announcement is saying that they will completely buy out these two companies at a consideration of approximately $160 million, and they can choose to pay with either cash or shares at Zip's discretion. Now, personally speaking, in these macro conditions when inflation is rising and potentially interest rates in the future as well, it will be much better to fund this transaction with as much shares as possible because Zip is still not making money. They will ultimately need to tap the equity market and the debt market in the future for more funding. So cash is going to be harder to access down the track based on the current environment. As minimal amount of cash as possible will basically give Zip more runway to last longer without having to tap capital markets for more money. And as many of you know, the current macro conditions is just not very conducive for companies like Zip. Since February, this company have essentially corrected around 48%, and rightfully so because the company is still not generating earnings yet. It's a growth stock, so you don't really expect them to generate earnings so quickly. And then if you're interested in the company, I like to do the exact same thing as what I did to AMP. First things first, I will go to Morningstar and check out the valuation gauge to see if there is enough incentive to keep digging. And you can see that the fair value to last close is relatively $1 worth of gap. And Morningstar is currently saying that Zip is fairly valued. If we want a confirmation on valuation as well, we can go to ticker and then go to valuation. And then we go to EV revenue because most of these companies don't have earnings, so therefore no EBITDA at all. I've added Afterpay and also Affirm in here as well. Drag it to 3 years. Well, Affirm only has a short amount of data, and you can see that Zip is currently trading at 14 times and their average is about 10 times. So it's still trading above its EV revenue. And not to mention that Afterpay is relatively high above its average as well. So is Affirm. Now, on top of the fact that these buy now, pay later companies is trading above its historical EV revenue, higher inflation, which is the current environment, will ultimately lead to higher interest rates. And higher interest rates is actually going to increase the cost for these buy now, pay later companies because, firstly, they have to borrow money from the debt warehouses to pay the merchants. And if that cost of borrowing goes up, they have the choice of either pass that cost onto their merchants or cop it themselves. And I'm really not sure whether these buy now, pay later companies have enough pricing power to actually pass on the cost to their customers. And secondly, rising interest rate in the future is going to make it harder for these companies to tap the equity market or the debt market for capital. Remember, these buy now, pay later companies are not generating earnings or have good cash flow, which means that they will eventually have to tap these markets for more capital. So what I'm trying to say is that in these macro conditions, which is really not favorable for these companies, I am choosing to avoid it because my objective is to get to financial independence sooner rather than later. And I think that if I could just focus on high quality decisions by avoiding some of these choices, I'll get there faster than I expect. But what do you think? Do you think that there's an opportunity with AMP? And do you think that there's an opportunity with the buy now, pay later companies? So thank you for watching this video all the way to the end. If you want to support the channel, not to mention access to additional content pieces and be part of my fortnightly Q&A, consider supporting the channel via Patreon. Nevertheless, if you have learned something new, remember to gently smack the like button right there, subscribe to my channel so that when I release future videos, you be the first one to know. Until next time, my name is David. Otto will always do the honors, and see you very, very soon.